Hey guys, welcome back to TradFi and Bitcoin Club. So today I will be discussing about Basel's 1250% mistake. What is the report? What are they talking about? What is capital? Uh, how the capital works in banking? So yeah, a lot to discuss. Um, I think I should first, instead of going into the report directly, I have to cover some basic points. So just I am shifting my screen to my iPad. I hope white screen is visible now. Yeah, it's visible. So uh, all of us know like how loans are being given by banks, how things work. So uh, it's a very basic formula where A equals L plus E. So A is equal to L plus E. So A is assets, L is liabilities, and E is equity. So let's say um, a bank has assets worth $100. So they the out of $100, 95 will be like for example, what are banks assets? Do you guys have any idea what are banks assets? In general, if a bank is giving out loans to businessmen, to consumers, that loans are generally banks assets, because from there they are able to make money or generate income. So let's say like they have issued $100 worth of loans, and out of this $100, $95 come from deposits of you and I, retail businesses, all we deposit money in the bank, right? So out of this $100 issued loan, $95 come from us, and the extra $5 comes from the investors who invest in bank. So this is equity part. Now you understand exactly where the capital comes from, right? So out of this capital, it's compulsory for investors to have this number, a good amount of this number. Like in our example, I have taken it as $5, but it depends. Like what kind of uh, like uh, what kind of investments, or what kind of capital do you have? So there is a variety of capital which you can have in banks. For example, you can have bond. Like for example, I'm an investor in a bank. I put in some X amount of money. Now it's obvious that I will not keep that X amount of money just sitting idle. I will be buying something from it. Like let's say I buy some sort of a corporate bond, or I invest in some equities, or I buy some gold. So all these things can be done in the equity side of things. Now coming to the MCR. So what is MCR? MCR is minimum capital minimum capital ratio, where it's calculated as capital by risk weighted assets. So what are risk weighted assets? Anything which you have in these equity part of $5. So anything and everything. For example, let's say as I gave you some examples of corporate bonds or equity shares. You all of you might agree with me here that corporate bonds has a different risk profile than let's say equity shares, or gold is also one of the capital which you can have in a bank. So these are all kinds, different kinds. So let me write it here: gold, then bonds. Now in bonds we have two types of bonds. One are T-bills or government bonds, and the others are like corporate bonds. In corporate bonds also we have multiple types. One is investment grade, and the others are like junk. So I don't know if I have discussed this earlier. So in the bonds which come above triple B are generally called as investment grade, and the bonds which are below triple B are junk grade. So triple B, then comes exact order. Yeah, like I'm not like don't take me on here, but exact order I can Google it. So these are credit ratings which are issued by like credit rating agencies. Like there are different kinds of agencies. Like one is S&P, and so yeah, here it is. Let me share the screen. So these are bond credit ratings. So every credit rating above triple B minus is an investment grade, and below triple B minus is non-investment or high yield junk grade. So these are like different types of credit ratings. Um, Coming back to our topic, which I was discussing, is all these different kinds of bonds are considered in the equity portion of the banking capital. Now, coming to our example here of MCR and whatnot. So MCR is basically minimum capital ratio. So in general, MCR is 8%. So for example, a bank issues 100 million of loan, then it needs to have $8 million in of let's say 0% risk weight. So what are 0% risk weight assets? Assets like gold, assets like T-bills. These assets are usually have 0% risk weight. So risk weight is a norm developed by Basel. Basel is one of the banking regulatory authority which sets banking standards. So they have set some um standards wherein gold is 0% risky. Bonds, T-bills, especially AAA, or when you consider, for example, US treasuries, it is 0% risky. And when you come to corporate bonds, they come at 20% risk. Then so this all is different types of risk which comes with different types of assets which we have. um, Now coming to our here, so this 1250 number is basically Bitcoin's risk weight. So if a bank wants to own Bitcoin, things here are like how rules are made is like does not made sense to me. Like for example, a bank is giving custody or providing custody services to like some of the public companies. Let's say strategy wants to custody their Bitcoin, have a multi-sig custody with, let's say, JP Morgan or Morgan Stanley or any of the banks, Bank of America. So if strategy has given this custody to, let's say, one of the bank, let's say for our example, JP Morgan. So JP Morgan, uh, in case of JP Morgan, if strategy does this multisig of $1 billion, then JP Morgan has to keep aside another 1 billion just because of this MCR. Now, how to calculate this MCR is, here they have done the math for us. Yeah, I think I need to change the screen. Yeah, I hope you guys are on the capital like the Bitcoin Policy Institute research screen. Yeah. So this is how it looks for bank. Let's say $100 million Bitcoin position. Now bank like the example which I give. In general, bank do not get any exposure because they are literally providing custody solution. But because of this criteria, the risk weight for Bitcoin is 1250%, and risk weight of asset becomes $100 million into 1250%. It becomes like nearly 1.25 billion. And when you come to minimum capital ratio, it is 8%. So multiply 1.25 billion by into 8%, it comes to 100 million. So what does that mean? That means for every $1 of Bitcoin which you hold, you have to have another $1 in like $1 equivalent of US Treasury, or $1 equivalent of, let's say, dollar bill. So this is kind of weird because um, it does not make any sense for me, guys, because like for all other assets, this is the chart where triple A sovereign grade credit is 0%. So when you do this math for triple grade sovereign instrument, let's say you have an exposure of $100 million worth of US Treasury, and the risk weight is zero. Here for Bitcoin is 1250%, but for like this US Treasury it's zero. So 100 million into zero, zero. And when this amount comes zero, the minimum capital requirement also comes to zero. So when you are holding US Treasuries, you do not need to hold any other asset. Same case in terms of gold. Gold also has 0% risk weight. So, is anybody unmute? Please mute yourself, guys. X256. Yeah, thanks. So yeah, these are risk weights. Let me come to our iPad screen so that I can do some calculations and help you. Yeah. So I was talking about some examples here. This is gold. This is US Treasuries. Then comes corporate bond. Let's assume AAA. AAA grade corporate bond. And what was the last? Yeah, our Bitcoin. So risk weight for gold is 0%. Risk weight for US Treasuries is 0%. Risk weight for corporate bond is 20%, and risk weight for Bitcoin is 1250%. Do you want equities also? Let's take it here. Equities. I think equities have 80%. Let me check. So corporate bonds is double A, not triple A. Equities is 100%. 100%. Okay. Risk weight for equities is 100%. And what else is remaining? Speculative unlisted equity. Oh, okay. So we have startups as well, which have not been listed yet. So let bank can also have exposure to startup guys. Crazy. So it has a risk weight of 400%. Now, as you can see, highest risk weight has been given to Bitcoin. Bitcoin trades 24/7 into 365. It has daily liquidity of around 20 to 30 billion dollars across the exchanges and across whatnot. So it's kind of crazy to see these risk weights here. Uh, Now coming to calculation, I am assuming $100 million of like $100 million in every asset. So when I do the math here, I will do the math for minimum capital that is required, which is 8%. So this 8% comes from a law, uh, comes from Basel norms. So when you have gold, 100%, 100 million in gold, you need to have the formula goes like this: amount invested in gold. So let's call it as exposure in gold, or let's call it E, then multiply it by uh, risk weight, risk weight into, then you have 8%. So it comes to, because the risk weight is 0 for gold, exposure is 100 million, risk weight is 0, and our minimum capital ratio is 8%. Essentially, because of this 0, everything collapses to 0. Same is in case of US Treasury, 0. Now in terms of corporate bonds, formula will be 100 into 20% into 8%. So the number will come to, let me like use the calculator. 100 into 20% is 20 million, and 20 million is 8%. So 20 into 8%, it comes to 1.6 million dollars. So this is how it looks in terms of when you hold corporate bonds. Now, when you come to Bitcoin, things are like weird because of 1250% of the risk weight which they have given. So you have exposure of $100 million into 1250% into 8% of capital required. So it comes to $100 million. In case of equities, $100 million into 100% into 8%. So it comes to 100 million, 100% is 100 million, and into 8%, so 8 million. So when you invest in equities, you need to have capital of $8 million. When you invest in corporate bond, you need $1.6 million. When you invest in startups, coming to startups, 100 million into 400%, into 8%. So 100 million, it comes 400 million, and 400 millions 8% is, I think 400 into 8% is 32. So even though if you invest in startups, you still need 32 million, which is one third of Bitcoin's amount which you will need. So it's kind of crazy thing happening here. Now let me come to bank's business. Uh, for example, a bank's target is like uh, we want to generate 12% ROE. 12% ROE. So what is ROE? ROE is return on equity. So I know this session is like all numbers, all corporate finance and whatnot, but unless and until you understand this, whatever report which we have, understanding that would be difficult for you guys. That's why I'm doing this math or running this math here. So in case of I want to generate 12% on my equity. So equity is this, what I talked about here. So on my equity capital, I want my bank wants to generate 12% of returns. So when in case of Bitcoin, because of this minimum capital required is 100 million, the return on this 100 million which I will need to generate is crazy. Like I will need to generate 100 million into 12%, which comes out to 12 million, $12 million. So generating $12 million from Bitcoin would be difficult because Bitcoin does not give you yield. And unless and until you rehypothecate, get into some shady stuff, generating $12 million is like very, very difficult task. But now let's say I want to generate 12% ROE on corporate bond. So 12% ROE in corporate bond is $1.6 million into 12%. So what is that number? 1.6 into 12% comes to 0.192 million. So around 200K. So like for example, when you have invested $100,000 in a corporate bond, I took it from here. When you have invested $100,000 from corporate bond, generating 200,000 is like very easy task, because that bond will be giving you 5, 6, 7, 8%. And uh, so 100 million into 8, or let's not take 8%, I will take it 6% into 6% is coming to 6 million dollars. So already you are by far exceeding your return on equity when you have corporate bonds. But in case of Bitcoin, to generate this $12 million, assume our example of strategy. Strategy has custody with JPM of, let's say, 100 million. Now on this is Bitcoin custody, BTC. Now this 100 million, JP Morgan has this Bitcoin custody with them in on behalf of strategy. Now uh, when you in case of Bitcoin, they will have to generate $12 million to like whatever they have internal targets of generating ROE of 12%. So unless and until they generate $12 million, they will not hit this ROE. And if they do not hit this ROE, all this business model will not happen, will not take place. And if this business model will not take place, where will strategy go to do custody? They will go to some offshore companies or some exchanges like Coinbase, which are offering custody services at like um, for example, to generate 12 million, they will have to charge strategy 12% of a total custody amount. So this is huge. Coinbase offers custody at 0.5%. So for 100 million, strategy only has to give like 0.5% of it. 100 into 0.5% is like zero point 0.5. So nearly 500K. So when you compare $12 million with 500K is nothing. That's why business model is not happening with banks. That's why banks were not doing custody. So now, because of SAB 121 has been removed last year in January, and you still have this Basel 1250% risk weight, it's not making sense for banks to generate income or provide custody services. Basically, business model is not fitting in here. Now I think you guys have basic understanding from this. Now I will share the report and let's get into the report. Yeah. So this is executive summary. So where does this 12.50% of risk exposure comes? It comes from here. Crypto asset exposure SCO60. So from this 12.50% risk weight comes in group 2B. So I have discussed this. Now, what are the recommendations which Bitcoin Policy Institute is giving? The first and immediate recommendation is clarify that pure agency custody where bank takes no principal risk. Now, when you are custodying Bitcoin for other entity, basically you are not, what I can say, you are not having any exposure to the underlying asset. You are just custodying it on behalf of your customer. In our case, strategy. So in this case, clarify that pure agency custody where the bank takes no principal risk, like whatever happens to Bitcoin. Let's say Bitcoin goes to zero. What I'm what is the risk to me as a bank? Nothing, right? Because it's not my Bitcoin. I'm just custodying it on behalf of strategy. So provide a supervisory pathway for limited Bitcoin intermediation with inventory limits and audited custody standards. So this is immediate thing which US government or any regulatory authority which comes, they need to classify it under this. Now coming to the second part, medium term. What is the uh, second advice? Second advice is Basel engagement. Replace the fixed 1250% default with a conservative FRTB based market risk approach. Now, what is this FRTB? FRTB is basically it is for volatile. It's a framework for. Let me just tell you the full form here. So FRTB is Fundamental Review of Trading Book, is a Basel Committee on Banking Supervision. So FRTB is a framework where they do some risk analysis of of the assets which trade continuously on an exchange, let's say, or on something. So this is a framework. So what Bitcoin Policy Institute is saying, under this FRTB based market risk approach plus operational risk add-ons, you define a rational risk weight. Substitute graduated concentration limits for the binary 2% cliff. Now, this is new point which I have not discussed yet. What is 2% cliff? So this is kind of a weird thing with the law here. So, for example, uh, the bank has total assets worth of 10 billion. Out of that 10 billion, currently, if you are a bank, you can have 2% of it in Bitcoin. But the catch here is 2% cliff. So what is 2% of 10 billion? 2% of 20% is 2 billion and 2% is 200 million. So let's say if you are a bank and you have assets worth 10 billion, you can have $200 million worth of Bitcoin. But the catch here is, if this $200 million of Bitcoin goes even $1 above 200 million, then all of this Bitcoins will go to this category of risk weight 1250. So you have assets worth 10 billion and you have Bitcoin worth 200 million. And let's say Bitcoin pumped up 10%. Now you have Bitcoin worth 210 million. And because of this 2% cliff, which we have, the Bitcoin now becomes 210 million in our balance sheet. And because the laws and because the minimum capital required you need for Bitcoin is every dollar you need one more dollar. So for $210 million of Bitcoin, you need to allocate another $210 million to Bitcoin. So this is kind of a thing which needs to be removed in the medium term, which this paper is advising. Then comes long-term principle-based classification. Create a non-issuer digital commodity category with capital determined by measurable risk dimensions rather than technology labels. So as we all know, Bitcoin is a commodity. What is a commodity? Commodity is basically a thing where no one issues it. It's available in nature. So, how do new bitcoins come into supply? We mine it, right? No, like Bitcoin is not run by any centralized authority where they will say that, yeah, we are issuing bitcoins, new 1 million bitcoins are out there in the market. Yeah, nothing like this happens, right? Every miner does the proof of work, and from that proof of work, if like they win a block, then they get a reward, they get subsidy, and from that subsidy of 3.125, new bitcoins come into supply. So this is how bitcoins come into supply. So uh, Bitcoin, what they are saying that put Bitcoin in gold's category. So as I was explaining you here, these are risk weights of different assets. So risk weight of AAA grade sovereign debt is 0%. Risk weight of gold is also 0%. Now, I read it somewhere in the report where it says even if you are holding gold, or I think I have it here, under the standardized approach to credit risk CRE 20. So this is a framework, the Basel framework, that provides gold bullion held at the bank or held in another bank on an allocated basis. To the extent the gold bullion assets are backed by gold bullion liabilities, shall receive 0% risk weight. Now, what does this mean? We all know that gold is also similar to Bitcoin in terms of commodity. Like it is also a commodity. No one issues gold. We mine gold, right? So there is no default risk or there is no credit risk in terms of gold. What is credit risk? Now coming to credit risk is like, let's say a company or a corporate bond has a credit risk because corporate bond is dependent on the corporate to be going concern. For example, if Apple issues a corporate bond, that corporate bond will have a credit risk. And what will be that credit risk? The credit risk will be for how long Apple sustain their business. So this is what credit risk is. In gold's case, gold do not have any credit risk because gold is gold. No one is issuing it. It also do not have any issuer risk. But gold can have counterparty risk because let's say you are custodying your gold in some other bank where they said it here held in another bank. So if your gold is held in another bank, then you are having a counterparty risk. If that counterparty goes bankrupt and if that counterparty like denied you from giving your gold back, I know there are laws, there are regulations which will prohibit, or there might be some bankruptcy remote entities where I will put in my gold, but still all of this is in place. But you can't assume that the counterparty will give your gold back to you because they are the custodian. But in case of Bitcoin, uh, if you are doing self custody, then it's not true. Although I know the fact that I think the public companies need to have a custodian, but still, I think the 0% capital benchmark which gold has got, I think Bitcoin is also very close, if not similar. I think it's much better uh, when you compare it with gold, or I think you should take it as like very similar in category with respect to gold. Now I explained this $100 million. You will require 100 million if you have Bitcoin worth 100 million. Then what else is remaining? Yeah, one thing. Yeah, here this table. Now, as you can see here, um, it's a table where settlement time is discussed. Now, as we know, Bitcoin settlement time is 60 minutes. 6 confirmation blocks should be happening to, like, probably, the probability of the Bitcoin which you have received after 6 blocks, um, the like that transaction being called off is near to infinity. So that's why here 60 minutes is given. Some of you might think why not 10 minutes? The reason is this, because sometimes blocks like 2 blocks are mined in one in at some point. So these are some technicalities here. But yeah, the settlement time in Bitcoin is 60 minutes on chain. In Lightning, it's nearly instant. So then in gold, it's T+2 business days. So Saturday, Sunday off. Then like some holidays might be off. Mechanism is LBMA auction plus clearing. Then US equities is it's T+1, so transaction day plus 1 day. Then for US treasuries it is also T+1. For corporate bonds it's also T+1. So when you compare Bitcoin with all other assets which we have right now, the settlement time is way better. Then comes the part of transparency and auditability. Now, supply verification for Bitcoin, it's real time, right? You can go to mempool, you can go to like these all tools which you have, and you can real time audit it. You can run your own node, real time audit Bitcoin. In terms of gold, estimated relies on mining reports. So um, uh, basically how much gold is there, it is based on mining reports. There is not a lot of transparency there. Then comes transaction audit trail, complete immutable public ledger. But in case of gold, it's opaque OTC. Now what is OTC? OTC is like over the counter. So over the counter is basically there are few authorized participants or few exchanges which have rights to do these OTC transactions. And like for example, you are a big exchange, only then you will be able to trade OTC. LBMA. So LBMA is the entity, London Bullion Market. They report self-report holdings verification. We can generate cryptographic proof of reserves. The exchanges, some treasury companies do this. They generate cryptographic POR. In case of gold, you have to physically audit. I know 1 year back, there was a thing where everybody was saying on X that audit Fort Knox. So there were memes trading around that nothing is there in Fort Knox and whatnot. But yeah, so doing audit of gold is like, it's very hard. Then comes counterparty and transparency. Uh, Bitcoin is pseudonymous but fully traceable. Gold is bilateral, often confidential. Trading hours. Bitcoin is traded 24/7 into 365. So Bitcoin trades every time. When you compare it with gold, business hours of gold and 5 days per week. Price discovery. What are the price discovery mechanisms for Bitcoin? There are 197 exchanges and 2,553 markets. So the price discovery is like very much decentralized. But when you compare it with gold, two daily LBMA fixes plus OTC. So the price of gold basically comes from LBMA or the New York COMEX or maybe now Shanghai Gold Exchange. So when you compare Bitcoin with respect to gold, it is much better in most of the cases. Now, operational risk. What are the operational risks when you custody gold? When you custody Bitcoin? So there are some, operational risks as well, and there's also a framework which Basel has. So they can do operational risk analysis and consider a risk weight based on that. They call it OPE 25. So this is a Basel risk framework. Now coming to real big economy and banking system consequences. So this was what I was trying to give an example. Now there are many Bitcoin treasury companies or let's say Bitcoin holding companies which are holding Bitcoin in their balance sheet, but the current because of the current rules and current laws which are in Bitcoin, many banks cannot offer custody services because of whatever I explained you till now. So because of all of this, doing like custody is not what I can say is not a very easy task for bank, and that's why custodians are shifting, and that's why we need to have these exchanges like FTX and FTX got blown up last cycle. There were many other many other offshore exchanges which got blown off. So if US government makes these laws similar to the other assets which we have, then I think it will be a fair play to the other to the people who are doing custody, or to the companies who are doing custody, it will be a fair market. Now, coming to the global scenario, in case of EU, Singapore, Hong Kong, Switzerland, there are already regulatory frameworks which have been set up. All offer like 0% capital gains tax and clearing licenses framework. So these frameworks have been set up. Here they have not mentioned what are the risk weights associated with EU and Hong Kong or Singapore or Switzerland. But yeah, I think these things should also be considered by US, because US is basically like world's biggest capital market, and if they do not have like regulatory frameworks, then um, like it will be not good for Bitcoin or not good for the US or not good for the US companies. So again, coming to reform agenda, what we can reform it. So basically, in the earlier part here, they mentioned it. Yeah. So this immediate, medium term, and long term. So here they are like expanding the same. What should we do? What reform should we do? So tier one is immediate near term, where they clarify that pure agency custody and safekeeping, where banks hold no principal position and takes no market risk. Bitcoin remains off balance sheet. So in this case, why are you asking us to keep aside our own capital? Like, make this a clear point. This is the first like reform which we want to have. Then the second reform is replace 1250% of risk weight with FRTB based capital. This is a framework which I told you, fundamental review of a trading book. So according to this framework, make it to Bitcoin as well. Then replace this 2% binary hard cap cliff. Do not like, why is this cliff even here? Then tier 3 long term, classify by risk, not technology, assets with zero counterparty credit risk, deep derivatives market, continuous price discovery, and cryptographic auditability should not automatically receive the framework's maximum penalty weight. So as I was explaining you to the in the earlier section, Bitcoin is much way better than gold. Then yeah, volatility should be considered. Bitcoin is volatile, I agree, and that volatility will be like considered with this FRTB framework. Now FRTB framework does the math for equities and I think bonds also. So why not do Bitcoin with also in from FRTB framework? Then also consider liquidity, also consider operational complexity, consider concentration risk. Like, for example, one bank cannot do X amount of custody. Like, you can make these kinds of rules, but why are you giving us 12-50% of risk weight and whatever 2% cliff? And even if a bank is custodying for somebody else, for third party, then also you have like the bank has to say, keep separate Bitcoin, separate dollar holdings. So remove all of this. So yeah, this was the session.